Early part of this year, Jeremy Siegel made a remark that 75-25 is the new 60-40. I'm sure if you're an advisor or a seasoned investor, you understand what I mean. He said since bond yields are so low, you should allocate only 25% of your money to bond yields and 75% should be assigned to equity investments. I honestly do not know how good this investment advice is for the 70-year-old man or the 65-year-old man. Can he afford to put more money into equity at these stretched valuations and risk the factor that he will have to draw down when the market is worse than where it is today? I seriously don't know. But I also don't think that you should worry too much about interest rates being low. It could get lower and then it could get higher, right? So don't worry about interest rates. Start writing down your expenses. Knowing the inflation impacting you is far more useful than worrying about the number which Nirmala Sitharaman gives and saying, it can't be so low. I go to the market every day. I know what it is. But you're still bluffing. To be able to accurately predict what is happening to your portfolio, step one is to maintain an expense diary and an investment diary. Remember, I've said and an investment diary. Your expense diary should write down all detailed expenses, right? And the fact that the greater the detail that you write down, the greater the detail which will be how you can use it. For example, certain vegetables could be cheaper in particular part of the year, and some other vegetables could be cheaper in different parts. If you do detailing of your expenses, you will even be able to find that trend. But if you know that you're too lazy to do it, I wouldn't do it. Then don't bother, but just break it into vegetables and fruits so that you know the vegetable inflation and fruit inflation are two completely different animals, right? I've always found that fruit to be more expensive because I pay more at the fruit counter than I pay at the vegetable counter, and fruit I may be the only person eating because my wife buys fruit separately, right? So the fruit budget may be higher than the vegetable budget. When you write down all these expenses, you know what is the inflation rate applicable to you and see what is happening. Just keeping on putting more money into equity, hoping that equity will do well, is a very good strategy for the 30-year-old, but it may not be very good strategy for the 70-year-old. So be careful about that. Don't keep on increasing your equity portfolio size just because there is somebody saying interest rates are low. It does not mean anything. If interest rates start going up, remember your equity markets will come down, so you need to be in liquid funds so that you can move from one asset class to other. So if you put say 30-40 lakhs in short-term income fund and it's more than 3 years old, remember it's available to you. So you may want to remove from there and put it into some equity fund, some US fund, whatever. So get your asset allocation right. Don't worry too much about interest rates. You cannot be worried about that. Also remember, the return that you get in equity depends on your starting point to a great extent. This is not a great market to be starting to invest without understanding what is happening. It's a very cruel, one-way kind of a market. The FANG is making money. Yes, Reliance is perhaps piggy banking on the digital thing and making money. It does not mean other companies will make money. It does not mean other companies are a good buy or a bad buy. You have to apply your mind. If you do not know how to apply your mind to direct equities, there is always mutual funds on which you can fall back on. Make sure that the funds are performing reasonably well. Spread it across 5-6 funds, across categories, and that's it. That's what you need to do. Thank you.